Listen up, because this is important. You can't compare apples and oranges. It's the same with stocks. Different sectors, different rules. Tech companies soar with growth. Banks thrive on stability. Trying to value them the same way? That's a recipe for disaster. Think of it like this: a fancy restaurant and a hot dog stand. Both sell food, right? But their business models are totally different. You wouldn't value them the same way. The same goes for sectors in the stock market. Tech companies are like growth stocks. They're all about innovation and expansion. Think Tesla or Amazon. Banks are more like value stocks. They're about managing risk and generating steady income. Think JP Morgan or Wells Fargo. Bottom line, don't be fooled by superficial similarities. Sector-specific analysis is key to making smart investment decisions. All right, let's talk ratios. These are your financial tools, the magnifying glass to examine companies. But remember, different sectors need different tools. For banks, it's all about the PBV ratio. That's price to book value. It tells you how much you're paying for a bank's assets compared to their value on the books. Low PBV can mean a bargain. High-growth sectors like tech, PEG ratio is your friend. It factors in future earnings growth. Remember, these companies are all about potential. Infrastructure and utilities? Think EV/EBITDA. This ratio compares a company's enterprise value to its earnings before interest, taxes, depreciation, and amortization. It helps you understand the true value of these asset-heavy businesses. Online retail, price to sales, PS, or price to gross merchandise value, PGMV, are key. These ratios reflect the rapid growth and unique economics of e-commerce. And for most other sectors, the trusty price to earnings, PE ratio, is a good starting point. It tells you how much you're paying for every dollar of a company's earnings. Remember, ratios are just tools. Knowing which tool to use and how to use it is what separates the pros from the amateurs. Let's dive deeper into banks. Why PBV? Because banks aren't like your typical businesses. They use debt, a lot of debt. It's called leverage. Think of it like this. You buy a house for $500,000 with a $100,000 down payment. You just leveraged yourself 5-to-1. Banks do the same thing, but on a much larger scale. PBV helps us understand how much value a bank is creating with all that leverage. A PBV of 1 means you're paying exactly the book value of the bank's assets. Less than 1? That could be a sign of undervaluation. But remember, leverage is a double-edged sword. It can amplify gains, but also magnify losses. That's why banks need to be carefully analyzed. Bottom line, PBV is essential for understanding a bank's financial health and its potential for returns. Section 4, Clicks to Riches. Valuing the digital marketplace. Now, let's talk about online retail, the darlings of the stock market. These companies are growing like weeds, but traditional valuation metrics often fall short. That's where price to sales, or PS, and price to gross merchandise value, or PGMV, come in. PS compares a company's market capitalization to its annual revenue. It's useful for valuing companies that are growing rapidly, but may not be profitable yet. Think Amazon in its early days. PGMV is even more specific to e-commerce. It considers the total value of merchandise sold through the platform. This is crucial because online retailers often don't own the inventory they sell. These ratios help us capture the unique dynamics of online retail: rapid growth, low operating costs, and the power of network effects. Remember, the online retail landscape is constantly evolving. New business models are emerging all the time. Staying ahead of the curve is critical for success. Section 5. Banking on value, spotting hidden gems. Now let's put our knowledge into practice. How do we spot undervalued banks? Remember the PBV ratio? It's a good starting point. Look for banks with a PBV ratio below 1. This could mean the market is undervaluing their assets. But don't stop there. Dig deeper into their financials. Check their return on equity, or ROE. This tells you how efficiently a bank is using its equity to generate profits. A high ROE is a good sign. Also look at their non-performing assets, or NPAs. These are loans that aren't being repaid. A high level of NPAs can indicate trouble ahead. By combining PBV with other financial metrics, you can identify banks that are trading below their intrinsic value. These are your hidden gems.